Welcome to UB Invest Academy, where we simplify financial concepts for retail investors. Today, let's understand how bonds are taxed so you can make sure you're getting the most out of your investment. The first thing you need to know is that interest income from most of the bonds is taxable. The amount of tax you owe will depend on your income tax bracket. The interest income earned is added to your total income and taxed at the applicable income tax slab rate. For example, if you buy a bond for Rs 10,000 and it pays an annual interest of Rs 1,000, the interest income will be taxable and you will owe Rs 300 in tax if you're in the highest income tax bracket. If you sell a bond for more than what you paid for it, you'll also owe capital gains tax on the profit. The amount of tax you owe will depend on how long you held the bond. For example, if you sell the bond bought at Rs 10,000 after 3 years for 11,000, you'll have a capital gain of Rs 1,000. The capital gain will then be taxed at a lower rate, so you'll owe Rs 200 in tax. There are a few types of bonds that are exempt from taxation. These include municipal bonds, which are issued by the state and local governments, and government bonds, which are issued by the central government. When you buy a taxable bond, the issuer will typically deduct a tax at source, which is TDS, from the interest payments. The current TDS rate for bond interest is 10%. This means that the issuer will withhold 10% of the interest payment and pay it to the government on your behalf. If you buy a bond at a discount, meaning its price is lower than its face value, the discount is considered as capital gains and taxed at the applicable income tax slab rates. If you buy a bond at a premium, that is at a price higher than its face value, the premium doesn't have any immediate tax implications, but it's also not eligible for any deductions or exemptions when calculating taxable income. Here's a quick comparison to understand the taxation of bonds against debt mutual funds and FDs. When a bond matures or is sold before maturity, there are tax implications to consider as well. Upon bond maturity, the investor receives the principal amount, which is tax-free. However, any accrued interest earned over the bond's term is considered as an interest income and is taxed at the applicable income tax slab rates. If a bond is sold before maturity, any capital gains or losses realized are subject to taxation. Capital gains on bonds held for less than 36 months are classified as short-term capital gains and are taxed at the applicable income tax slab rates. Bonds held for more than 36 months are considered long-term capital assets, and capital gains are taxed at a flat rate of 20% with indexation benefits. If you are considering investing in bonds, we encourage you to consult a financial advisor to understand the tax implications of your investment in detail. Happy investing!